What I wanted to do was kick off just with a quick summary of what is angel investing. Before I do that, though, just a quick about myself. My name is Tim Kelly. I head up entrepreneurship here at GCU. Been teaching now for about 7 years. They keep me around, they let me tell stories, and somehow they pay me. The growth here at GCU has been extraordinary. There's probably few universities like GCU that have such an entrepreneurial spirit anywhere in the country, if not world. Just a quick touch of history here. Founded in 1949, small teachers college. Low growth, almost nothing till the 2000s. We became a public have grown an online platform. Our ground campus now has 20,000 students here, 14,000 of which live on campus. We also have over 80. With that being said, I also head up our group here called Canyon Angels. We started this about 3 years. The purpose of doing two things. One is opening up the angel environment to bring more people into the community to invest in startups, and also give our students a chance to be a part of the learning curve of an entrepreneur from the perspective of an investor. And so it's really about building that community, exchanging those ideas, and growing the community overall. Got a quick few little slides here I'm going to walk through because I think it sets the stage. The mission of today is to grow the angel investor community. A quick stat that I've heard that I have yet to see where it really comes from, and probably one of you can tell me, but I've heard that there's about 140,000 accredited investors in the Valley. That means individuals with essentially a high net worth amount that could be able to invest in startups. But of those that are active in any angel communities, you're in the mere hundreds. So our mission is to help change that. And that's kind of what today's presentation is about. Today's discussion is all about that. And I wanted to set the stage in describing what is angel investing. So I've got just a few quick slides here to share. This is information that I stole from what is called the Angel Capital Association. And it's the leading organization of angel groups worldwide. They have over 15,000 members. And what that represents in this concept of angel investing is early stage, high growth opportunities. These are startup companies that have some proof of concept and need capital in order to scale to that next level. It represents an investment of about $25 billion per year in the US. You're looking at it makes up of the way companies get funded. About 90% of how companies get funded out there is through this type of angel investing. It's equity. We're taking ownership in these companies. But just 3.8% of angel investment in the United States is done in the Southwest region. That's Arizona, Nevada, New Mexico, and Colorado. This is about changing that. Right, Sandra? So this is a little chart that I put together. It's kind of funny and kind of weird, but what I'm trying to say here with this, and I'll put on my professor cap now, this line, this big blue line going up represents increased amounts of capital that companies are seeking. And when they start off, we know that so many of our entrepreneurs start with their personal savings. They may do a home equity line, they'll cash in their 401k, whatever it is, they've got to bet on themselves first, is what we expect. There's a new phenomenon, well, it's not so new these days, but called crowdfunding. And often now we use it as a way for startups to validate their concepts. These are things like GoFundMe, Kickstarter. Companies have raised tens of millions of dollars in pre-sale campaigns, even through organizations like AngelList, where they actually are able to syndicate equity positions online. Fascinating phenomena. It's a big part of it. But then you get hit up as friends and family. Sometimes we call us friends, family, and fools. Hopefully, many of you that are angel investors or accredited investors, you've been hit up probably by people saying, hey, I got a great idea, come invest. It gets difficult when you're in that position to truly have a mechanism to vet these deals. The benefit of angel investing groups is that we come together, we bring resources together to vet those deals. It's a process, it's a procedure that helps us mitigate the risk that is inherent in investing in these early stage companies. So friends, family, and fools kind of get that first step here. We hope that that next level is angel investing. That's where we are systems, we are procedures, we are groups that come together to pool capital and make that early stage equity investment more possible. Then banks, venture capital, and IPOs. And generally they go up the ladder. You're talking tens of thousands here, hundreds of thousands here in the angel category. Banks, venture capital, 10 million and up, IPO, in the hundreds of millions and billions. That's sort of the scale in which we play. Hopefully pertinent to every angel investor is this idea of a portfolio. How do you build up a portfolio of early stage companies that represent some level of diversification? What we have here is another statistic from the Angel Capital Association, one of their presentations, and they're talking about how many investments you have and what's the probability that you're actually going to have a return on your investment, because this is high risk. So if you have 6 companies in your portfolio, you're looking at a 50% chance that you'll get your money back. All right. If you have 12 companies, you're looking at probably a 75% probability of a 2.6 times, 2.6x times your original investment. 48 investments, 95 probability of that 2.6x. That's their statistic. Every group is different. Every situation is different. But the simple metric is that by being able to build a portfolio, you can mitigate your risk. And so many of the structures that we have together as angel groups is about helping you build. We'll dig into that when we are in our process. Who is an accredited investor? This term sounds scary sometimes. What does it mean? Quite simply, a net worth of $1 million, excluding your primary residence, and 2 years annual income over $250,000. Married couples. That's what it means. There is no agency that comes out and makes you take a test. Government, well, the IRS. But you don't have to take a test. It's self-certification, vast majority of cases. But that's it. That's what an accredited investor is. And with that, we have the great honor of having Sandra Watson with us. She is the CEO of the Arizona Commerce Authority, our entity that is vital to organizing economic activity here in Arizona. And with that, I just pass it over to Sandra. Let's give her a hand.
I'm excited to have the opportunity to speak to such an impressive group of angel investors and entrepreneurs. Thank you for being here today, and special thanks to Tim and his entire team for inviting me. I have a very cool job. I work with an incredibly talented group of leaders at the Arizona Commerce Authority. The ACA, not to be confused with the Angel Capital Association, is the state's leading economic development organization chaired by Governor Ducey with a focused mission to grow and strengthen our economy. A substantial part of that mission is to ensure that Arizona remains the best location anywhere in the world to launch, test, and scale new ideas, technologies, and business models. If you're in the audience today and you're not familiar with Arizona's business environment, you might be asking yourself, why should I start a company in Arizona? Why should I invest in startups? Once you fully realize the quality of Arizona's entrepreneurial talent and the resources in the ecosystem, you'll find yourself asking, why not? Many of you know Arizona as the Grand Canyon State or the Copper State, but to borrow a phrase from Governor Ducey, the startup state has also earned a place on the list of Arizona that is recognized. Not only are we a young state, but under Governor Ducey's leadership, Arizona has established a global reputation as a hotbed for innovation and a leader in emerging. In fact, just 3 weeks ago, we hosted the 2018 Arizona Tech Innovation Summit with the Arizona Chamber, APS, Field. Governor signed into law a bill making Arizona the first state in the nation to establish a sandbox program for developing and testing new financial technologies and products. Pioneering the FinTech Sandbox program is just the latest in a long list of accomplishments driving Arizona's leadership position. From policies enabling ride-sharing, home sharing, and equity crowdfunding, from supporting the responsible testing of self-driving vehicles to becoming the first in the nation to lay the groundwork for 5G technology. Arizona is dedicated to supporting technologies that are transforming industries and are truly unmatched in the country. Not only are we creating a forward-thinking environment that embraces transformation, we've created an incredibly collaborative, engaged, entrepreneurial ecosystem. Consider this. Less than 10 years ago, Arizona had not even a dozen incubators or accelerators. Today, we have more than 50 incubators and accelerators, as well as over 40 co-working spaces. The Kauffman Index ranks Arizona as a top 5 state for entrepreneurial activity. Arizona State University has been ranked the most innovative university in U.S. News and World Report 3 years in a row, beating out MIT and Stanford. Companies like Axon, Insight, LifeLock, GoDaddy, Infusionsoft, WebPT, Parchment, Campus Logic are all just a few of the many success stories that began right here in Arizona. Desert Angels, you'll hear from on the panel, is the third most active angel investing group in the country, and they're based in Tucson. They focus much of their funding in early stage tech and life sciences companies right here in Arizona. Governor Ducey, our elected officials, the business community, the ACA, and our many economic development partners know that small business and entrepreneurship are key components of a long-lasting, vital economy. Data from the U.S. Census Bureau shows that less than 1% of all companies are startups. Yet these same startups generate 10% of new jobs in any one given year. These impressive figures also highlight the critical role that angel investors play in building a robust and innovation ecosystem. Angel investors drive our economy by enabling startup companies to cross the bridge from great concept to initial round of funding. As you just heard from Tim, collectively, angels in the U.S. invest about $25 billion per year into early stage companies and provide 90% of outside funding for startups. Angel investors, like many of you here today, are key to helping entrepreneurs take their first step towards growing their companies. To support and encourage early stage investment activity in our state, Arizona offers an angel investment tax credit. This program allows investors to claim a state tax credit equal to 30% of small business investments or 35% of rural and bioscience company investments. It has proven vital to helping Arizona-based startups access early stage funding needed to begin scaling their operations. One of our angel tax credit success stories is Chandler-based Infusionsoft. CEO Clayton Mask said that the capital boost provided angel investors enabled Infusionsoft to raise an initial round of $9 million. The company has since raised $125 million through successive funding rounds, employs 600 people, and earned $100 million in revenue in 2016. The Angel Investment Tax Credit is an excellent tool, and it's part of a comprehensive suite of programs designed to ensure that early stage companies in Arizona are well positioned and prepared to pitch and receive investment. During the past 7 years, the ACA has worked to promote Arizona's innovation ecosystem through our flagship innovation program, the Arizona Innovation Challenge. We have received over 1,900 applications over the life of the program, and over 1,200 early stage companies have applied. 70 of those companies were awarded grant funding following a rigorous and competitive vetting process. This portfolio of companies have gone on to collectively raise an additional $168 million in investment. They also have been generating $140 million in revenue and creating 425 jobs. While the ACA does not take an equity position in any of these companies, we are investing in their growth and their success. In addition to the Arizona Innovation Challenge, the ACA also partners with the Invest Southwest to present Venture Madness, an annual live pitch competition and conference. Participating companies receive feedback and mentorship through the selection process, as well as the opportunity to network with active angels and accredited investors during the event. In addition to these competitive programs to help entrepreneurs and refine their pitches and connect with investors, the ACA offers long-term mentorship through a program we have called Venture Ready. Venture Ready begins by partnering a company with what we call an entrepreneur in residence, an EIR, an experienced private sector leader that volunteers their time. The EIR will coach the company through 5 panels. Each entrepreneurs pitch their business models to a panel of professional experts, and they receive specific points of feedback and identify gaps and strategic opportunities for that company. Venture Ready, the Arizona Innovation Challenge, Venture Madness, the Angel Investment Tax Credit certainly don't represent all of the activities in supporting startups and entrepreneurs, but they are key programs in our overall strategy to create successful new companies while growing entrepreneurship here in Arizona. I have been fortunate to work in Arizona with community and business leaders for many, many years. And I can tell you firsthand that the opportunities available in our state have never been greater. There is no better time to get involved, to start a company, or to make an investment. Please feel free to reach out to me or members of my team. I see Randy in the back there as well. If you have any questions or would like additional information on any of those programs, I'd now like to turn it over to our impressive panel of angel investors who will provide expert perspectives on what is taking place in our market. Thanks a lot, Jim.
Okay. Clearly, as Sandra said, this is a critical step in the way businesses grow in Arizona. And with that, I'd like to invite up our panel. Gentlemen, please come on up here. We have in our moderator, where is Nathan? There you are. So let me quickly do just a name introduction here. We have Nathan Mortensen as our moderator. He volunteered. I put him to work.
I get paid really well for my volunteer work these days.
Yes, that's true. He's also past chairman of Invest Southwest, and we just finished Venture Madness not a few weeks ago. To piggyback on a few things that Sandra said, what the ACA has done in supporting through the Arizona Innovation Challenge and Venture Madness is really extraordinary, because what it's done for all of us, and you all can comment, is provide a filter for these early stage companies to go through to discipline them on their expectations about what funding really means, characterizing their pitches so they actually don't last an hour, instead they can do it in a certain number of minutes that we might allocate, and an understanding overall of how it fits into the system. And with that, I guess I'll just take my seat.
All right. Can everybody hear me with the mic? Okay, awesome. So what we're going to do with this panel today is really try to cover three functions of investing. One is the what. What is angel investing and investing in startups in general? 2 will be the why. Why are you going to do this? And then the third one will be the how. Right? So we're going to try to cover the what, why, and how of investing to give us a good flavor of what it is and what to be conscious of. So to start with, as Tim mentioned, I'm Nate Mortensen. I'm a principal at Tall Wave Capital, which is an early stage VC fund based here in Scottsdale. We're the most active venture capital firm in the state, typically investing at seed and early Series A companies. So at the stage of capital, usually down the line or downstream from angel groups. And our focus is really help shine the light on what's going on in Arizona. So part of that was Invest Southwest and other events like this where we educate and help people understand the great things that are going on in Arizona. So with that, I'd like each of the panelists to identify, explain a little bit about who you are, and then go through and talk about what angel group you're representing, how long you've been around, how much money you've invested in, and what's unique about your group in about a minute or less each. So this is going to be a test today to see how well we can stick on time. So Gary, why don't we start with you, and then we'll come down this way.
I'm Gary Gibbons. I'm a professor of entrepreneurship and international finance at Thunderbird, which is now an independent college at Arizona State University. We've had an angel investing group since 2007, and over the time, I don't have the numbers quite off the top of my head, but we have been early on. We were very active. We had a period where Thunderbird was going through problems and we were less active, and then recently our activities began to pick up again. Personally, I've invested in 3 angel network deals in the last year and a half or so, and so I think recently our group is becoming we've just changed our name to Arizona State University in Arizona ASU Thunderbird Investment Network, so I hope you'll hear a lot more from us.
Thank you. Curtis?
Before I start, I want to ask a question of the group. So if you're an entrepreneur, raise your hand. All right, if you're an investor, raise your hand. All right, we're about 50-50. And if you're from Southern Arizona, raise your hand. Oh, I'm happy to see a couple of, all right, good. So I'm not speaking just to, so anybody from Tucson or Southern Arizona, come talk to me afterwards. My name is Curtis Gunn. I'm chairman of the Desert Angels. We are a group that's been around since fall of 2000. I was a little worried when you said 19, you started saying 19, because I know that we are the oldest angel group in the state. Since January of 2010, we've invested over $37 million into 76 companies. Last year alone, we did $6 million into 24 companies. Sandra stole a little bit of my thunder by saying we're the 3rd most active group in the country. Only caveat is that was 2014. Very proud of that fact. We were only beat out by Houston and Southern California, so we are a very active group. What else am I supposed to say?
I think that
Covered it? All right.
Yeah, good job. Jim?
I'm Jim Golka. I lead Arizona Tech Investors, which is here in Phoenix. We've been around for 10 years. We're 87 people. We've invested between $16 and $17 million in companies in the 10 years that we've been around. And importantly, we invest in IT across the board. We invest in life sciences across the board, but focus more on medical devices than diagnostics, and more diagnostics than therapies, and capital efficient green tech.
Awesome. Tim?
So, Tim Kelly, head of Canyon Angels here. We've been around for about 2.5 years. We've invested in about 12 companies under about $500,000 so far. Just building that momentum. Part of my motivation for this event is to grow those numbers.
Awesome, thank you. And I think one thing that's important to recognize is if you have that startup, founder mind, the entrepreneur mind, or the investor mind, is you have to start somewhere, right? And so I think the hardest part is getting those first couple deals done, either as a group or as an individual, because you learn a lot the first few investments that you have. So as we go to that, we'll start with Jim and Curtis, and really cover, this is kind of the sales piece, right? Why would you want to become an angel investor? And then how does someone become a member of your organization?
Why? Because it's fun. I mean, it's pure and simple. You get to see technologies at the cutting edge of innovation. You get to interact with directly very passionate entrepreneurs who think that, and sometimes too many of them think that they're going to change the world, but we want them all to think they're going to change the world. So it is fun. You get to see people and ideas and technologies that aren't yet available in the real world, especially in life science space. Sure.
So to add on to that, 2 other reasons. The first is we're doing this in order to make a superior economic return as part of a diversified portfolio of investments. So anybody that has investments in things like publicly traded stocks and bonds, they need to do some alternative investing. We're a way to do that, and we want to do it seriously economically driven. The second thing, so ultimately the third here, is that we're investing primarily in our own communities. We want to make our communities better. Startups add value by themselves. Successful startups create economic wealth that is reinvested in the community. Startups bring smart people to the table. Smart people make demands for things like better schools, a willingness to spend money on schools, and more of the things that make life worth living. So it becomes an overall life improvement by investing locally.
And the other question was, how do you become a member?
How do you become a member?
And I might speak out of turn, so I'll speak for my group, but I think this would apply to anybody else, any of the other group leaders here. If you want to come to one of our organized events, reach out to us and say, I want to come and observe the process and come to. We hold a monthly dinner meeting in Tucson from September through June. So figure out what the schedule is of any of the other groups, and as long as you're accredited, that is the gate to entry. Accredited investors will come and observe our process and hopefully join the membership.
So is it like a job interview process, or is it more if you qualify and you're willing to invest, you're welcome?
The latter.
Okay, good. So, because I might not pass interviews. All right. So Tim and Gary, what are the successful traits or skills to become a good angel investor?
Well, I think the first thing is to be dedicated, to come to the meetings, to take a lot of time and do a lot of homework on the presenting firms, to pay attention to them, to keep yourself educated about the various investment markets that you're a part of. Then I think being able to invest and being dedicated to investing over a period of time. If you just invest randomly and once in every great while, you don't have a very big chance of long-term success. So you saw the numbers that Tim had up earlier. Making sure that you build enough, even if they're small investments, but enough investments in a large number of firms is one measure of long-term success.
Yeah, I was hoping somebody would really answer that question, because I don't know the answer to that. What really makes a successful angel investor? I would say one thing though, by being a part of an organization, you mitigate the chance of the emotional influence from personal relationships that often steers those personal startup investments. That's one way. The other way is by a lot of the structures that certainly Jim and Curtis have, and we're launching as well. They're called sidecar funds. It's a vehicle in which you can invest smaller amounts of money, but yet get the diversification of 5, 10, 15, 20 companies in that one single investment. And so there's ways in which you can get to a diversified portfolio from the onset by being a part of one of these angel groups.
Yeah, and I think that's key. This principles for a venture investor and an angel investor are very similar. It's discipline, right? Being willing to say no, and then also the diversification of your portfolio. So broadly in venture capital, and I think angel group returns will probably fall into a similar bucket, but roughly half of the investments, you don't receive your full investment back or you lose all your money. So that's not good. The good news is about 6% on average of venture capital backed companies return over 60% of the capital to the fund. So you're looking for those special, diamonds that will return 10, 20, 30 times your original investment, and that's where a lot of the returns come. So it is about diversity. If you pick 2 companies, likelihood that those will all be very successful is a lot smaller than 20 companies. So it's the same principle that we have on the venture side, is the portfolio, the diversity, and you need to be committed and understand not everyone will win, and allocate the time to those that are most promising. So as we move on to the next section, so that's a little bit about angel investing in general. Then it's how do you find a deal, right? So it's great to say I want to invest, but how do you make sure you get high quality, good opportunities coming your way? And I see there's a lot of entrepreneurs here, which is a great sign. They're hungry for good capital and good investors, and there's not really a shortage of people willing to receive investment. The challenge is how do you find the right ones for your skill set for your angel group. And so with that, Tim and Jim, how do you source deals? How do you find investment opportunities for your angel groups?
So, we're in Arizona, and this is the real question. Are there good companies for us to invest in? So we don't have the luxury of sitting in San Jose and being really, really discriminatory about applications. Our front door is wide open. Anybody can apply to us. You come to our website, you can apply to us. Once we have that, then we will go through a process of selecting from all the applicants those that we think are most investable. So we start with, we're welcoming anybody. But beyond that, we talk to groups all the time. Any group of entrepreneurs that gets together, we're probably going to talk to and encourage them to apply to us. I have my usual suspects list of people I reach out to every cycle to say, hey, don't forget about us. If you're advising a company that is interesting and ready for us, please send them our way. And we take just random inquiries. I meet with a lot of entrepreneurs one-on-one. Some of them are ready. I just got an application for one that I met with last week, and some are not. But we actively solicit candidates for funding, because in that way we can get some good ones and we can provide feedback to those companies that apply.
Piggybacking on what Jim is saying, one of the benefits of what's I think called the evolution of our community over the last 5, 6, 7 years, largely based on what the AIC has done, the Arizona Innovation Challenge. We're seeing so many of these companies in our region pop up through that filtering process. Then they move up toward us, and we already see them in their first pitch. We're interested in them. That's number one. Number two is it's personal relationships. So I reach out to all of our members, we're nearly 60 members, and say, what have you heard? Have you found a company? And it's those that say, yes, I've invested in this, or I'm looking at investing in this. Let's have them come pitch to the group and see if it makes sense. And then the third is I depend on these guys. We collaborate, we syndicate, we're all on the same software platform called Procedure that allows us to share deals regionally across Tech Coast Angels, Rocky Ventures, multiple groups, meaning that a company then only has to really apply once and the information and due diligence can be shared. Sorry about that.
Technology.
Technology, right? That allows us to, basically I can leverage the work that they do to get deal flow to my members easier. And our structures are different. We'll get into that a little bit later.
Can I add a comment?
Yep, absolutely.
Something else that if not all of us, we all attend all the pitch events that go on through the state. Venture Madness, Idea Funding, AIC Challenge. So we're constantly on the lookout. So if you have an opportunity to get in front of an audience and pitch, there's likely going to be one of the angel groups, definitely going to be investors in the audience. So any opportunity to get in front of a group and pitch is healthy.
Yeah, and I think one theme that I echoed or I heard in here that I think is true across all capital stages is they collaborate, right? So if you apply to one and then you apply to another, Jim's probably going to call Curtis and say, oh, did they already pitch? How did they pitch? And the investors talk, they communicate. So if your story isn't true, if your story isn't consistent, that'll come out and that'll lead into the next question around how do you screen companies? But I think the general rule in Arizona is the angel groups and funds, we are very open to pretty much any conversation that can fit the potential interest of our investment thesis, which the angel groups is pretty much any potential company that has a compelling business opportunity you want a conversation with, right? And so along that line, the funnel comes in of all interesting companies. Now, what is the process within your angel groups on how you identify which ones move forward to the process for maybe the broader angel members that haven't been out there with all their feelers? Because I think that's a big thing about the angel groups is individual members don't have to do all the sourcing, and that's a benefit of being a part of the group is they can kind of be screened and brought to you. So Curtis and Gary, why don't you talk a little bit more about the screening process, what you're looking for in potential companies?
Sure. So Jim talked about an application process. Ours is the same on our website. I think we all use the same intake funnel, which is a platform called Procedure. I'm not sure. So that's easy. So we can share deals. One application on Procedure, you can hit all the angel groups in the state. For us, specifically at Desert Angels, All the applications that come in get reviewed by my partner who runs the group with me. His name is Base Warner. He's the chairman of our screening panel. Base reviews every application that comes in. If there's more information needed, he'll start a conversation with the entrepreneur to figure out what's missing. Every roughly 6 weeks, he puts together a screening panel, which is a Friday morning in Tucson at the business school in Tucson. We do 8 companies come in and do a face-to-face 10-minute pitch, 10 minutes of Q&A. From those 8, we pick the best companies to go to a dinner meeting. We have a monthly dinner meeting where 2 companies present at Hacienda del Sol in Tucson, so it's a nice place to come and have a dinner. So that's kind of our screening process.
Ours is very similar to that. We have a screening committee as well, and all of the applications get funneled through our screening committee. We have a couple of extra advantages right now. I think we have some joint ventures with some of the large healthcare providers. These are healthcare provider. One of them is Mayo Clinic Ventures. So they have their own fund. So they're looking at things all the time. We share contacts with them, and they don't have their own angel network group, so we have become their angel network group. So their prospects are coming through us. But otherwise, it's a very similar process.
So I think, the process is pretty similar. They get your application, they look at it, and they say, okay, now let's have a conversation to see if you'll pass that initial bar. So now they pass that initial bar, what materials should the founders or the entrepreneurs expect to provide to the angel groups? We'll start there. So let's start there with Jim and Gary. What material do you expect the entrepreneurs to provide you in order to have a good evaluation of the company? Gary, why don't we start with you?
For us, there's a minimum of 3 things. First of all, we want information about the market, the product, and the business model of the firm, and the team, the management team. Initially, those are the most important things to us.
Our process is a little more elaborate. Our application itself is comprised of 3 documents: a pitch deck, financial projections, and a laid out document that we call the ATI candidate template, which was created as our structure for due diligence. And so it asks 11 categories of questions in order even to get into our process. Once that happens, then we select a member to spend probably 6 or 8 hours with a company before they present to our membership, because at our member meetings, that person will do his or her view of the company, so we're getting a parallax vision of what the company's like. The CEO is expected to be selling real hard. We want somebody to have a different viewpoint on things.
Sure. And why don't we broaden this out to Tim and Curtis? Because I think what you'll see here is this is where the angel groups become a little different in terms of their internal workings. Screening and kind of the intake applications all the same because they use the same platform. And then based on the membership and their level of interest and availability and time, that's kind of where the process changes a little bit. So Curtis, why don't we go with you and then we'll get to Tim.
Yeah, the information is basically the same, but when we're in a screening process, we're at the screening panel, we're looking through the lens of what companies do we think that if we put them in front of our group will garner interest. That somebody in the group either has domain expertise or would be interested in possibly investing in this company. For us, if you get to a dinner meeting, if you made it through our vetting process, through the application, through the screening, you've got a 50% chance of getting funded. We fund half the companies. Historically, we've funded half the companies that made it to a dinner meeting. That's a pretty high hit rate. But we're looking at the same things. Team is very important. Technology, protectable competitive advantage of some sort. Financials, pro formas. Customers are great. Revenue is great. So if you come to us with those in hand, that's great.
We all like revenue, right?
Yeah. I will say a deal killer is irrational expectations of your valuation. We see it too often where entrepreneurs come and they're pre-revenue and they say they're 10 to 15 million pre, and it's just a non-starter. So educate yourself as to what reasonable terms are and expectations for financing. Also, this is probably the best time for me to say this. I want to say it in front of a large group. We, Desert Angels, do not do safes. We do not do uncapped notes. So don't come to us with either of those vehicles because we're not going to be interested.
Oh, sounds familiar. I like that. All right, Tim?
And if you don't know what those are, then go educate yourself.
Part of our process, so we have about 60 members. We also engage students in this process. And some of you maybe have met Spencer Vaz, our student leader, very persistent young gentleman. Part of what we do is bring in each of the candidate companies that meet that basic criteria, the same financials, some proof of concept, preferably revenue. We move them into our screening process, we film it so that we can then share it with our investor members. We then meet every Wednesday at 11 o'clock during the screening process and due diligence process. Our members are more than welcome, they're encouraged to come on campus, meet with our students and the companies that do these pitches every single Wednesday at 11 o'clock. It's a great working session, great way to get through these companies. Our students learn, we learn about what those companies are about, and we're hopefully able to screen out deals that are more exciting and more fun for our investors at the end of the day.
So here's a candid question. Of all the material that you're presented, how often is it 100% right after you've invested?
I've never seen a financial pro forma that's right. It's either high or low, often low. Yeah.
Yeah. So this is one of my personal investing pet peeves when they're like, okay, I can send you my deck, but I'm really fine tuning my financial model. And I think to myself, we know it's all going to be wrong because you're not in revenue. So it's okay. What you're looking for from a financial model is the market big enough? What are the specific drivers of the business, and what are those levers to pull that make a meaningful difference to the company? And can the company grow and scale profitably based on those economics? So I think that's one, tripping point that entrepreneurs sometimes have is, okay, my model has to be perfect. No, we know it's not perfect. It'll never be perfect. It's okay. What are the assumptions that are really driving your business? So as an investor, don't expect their materials to be 100% accurate. Don't bet on that specific revenue number. Use it as a guideline for what's really driving the business as an underlying reason on why to invest.
Yeah, maybe it makes sense to mention as well, the typical valuation at an angel level pitch is about 3.5 to under 5 million. That's just an average out there. So when things pop in that are in the 20 and $30 million valuations, most angel groups, it just looks out of their scope. Correct me if I'm wrong, but that's kind of one of the perspectives that we take.
Yeah, and I think as a general rule for investing or raising capital, expect to raise roughly 20 to 30% of whatever your valuation is, or that amount of dilution. So if you want to raise $1 million, your valuation will probably be in the 2.5 to 5 million range as a general guideline across most seed and angel deals.
I was just going to say another metric to consider when you're fundraising as an entrepreneur is raise 18 months of runway. Give yourself enough runway that you can achieve your next milestone, which hopefully you can do in 18 months, but also enough runway that you'll need to start fundraising for the next round, and you have enough runway to do that as well.
I want to add one more thing. What we're really doing is talking about those things that we call deal killers. Idiot valuations are deal killers. Bad numbers are deal killers. Misplaced expectations all around are deal killers. One that we actually have to talk about in addition to that is about governance. If you're an entrepreneur and you think you're going to somebody to get their money, they're going to give you money, and you're going to say, adios, I'll let you know how it goes. There is no opportunity there. No investor is going to do that. When you raise money from other people, and typically the money that you're raising, even at the earliest round, is a lot more money than you put into your business, expect that the investors are going to want to have a say in the governance of the company, which means probably board seats. A board comprised of 2 founders and 1 investor is a non-starter, for example. A board comprised of only insiders is even more of a non-starter. So the first question any entrepreneur really should ask himself or herself is, what do I want out of my business? If I want to control it all, don't go seeking money, it's a waste of your time. If you want to grow real fast and you need capital, and you're willing to share the ultimate decision making with other people who are smart and wanting to contribute to the success of the business just like you are, then it's time to have a legitimate and real conversation with any of us.
Can I add one more caveat?
Absolutely.
So when you come to us, when you come to Angels, We are the first round of capital you're raising outside of your circle of influence. So you heard about the friends, family, and fools. We are the first, I'll put air quotes, but the first professional money. So you're approaching people you don't know and asking for their money to invest in their money to invest in your company. When you do that, you are signing up for an exit event. You are saying to us, the investors and the world, that at some point in time in the future, you're going to grow this company to either merger, acquisition, IPO, or have some liquidity event for the investors. If the investors can't get a return on investment, we can't keep doing it.
And I think just some general metrics out there. On average, seed and angel deals over the last 24 months, they used to raise about $1 million. Over the last 24 months, that has grown to about $2 million in terms of round size. So you've seen round sizes increase. So companies raising money are raising more money, but fewer companies are getting funded. So about the same amount of capital is being invested out there in the market into less companies, but each company that raises is raising on average more. Then time to exit. From first venture round, which is probably another 12, 18, 24 months beyond an angel round, on average, an M&A event is about 5 years out from that point in time. IPO or a buyout is about 7 to 8 years. So then tack on another 2 to 3 years for an angel deal. Every investor will take an early exit that is profitable because it doesn't happen all that often. So this isn't a vehicle where you expect your money back every year or two. This is a long-term investment game. So expect to be in that company a decade, and then if it's before that, we're all positive. We're all pleasantly surprised on that, based on metrics. So, okay, so we got through kind of some of the screenings, the don'ts, what turns off investors. What are some of the key things, and this isn't in the question list. So, what are some of the positives that entrepreneurs can do, or signals that investors look for that really get you sold and pumped about a company? Kind of like lightning round here. So we'll just go down the list. Gary?
Personal commitment to the business. Put their own money in, put their own time in, make real commitment with real risk. That's number one. Cool.
Team, founders that know their domain, preferably maybe have done it before and are doing it again, but have expertise, know their competitive landscape, know the marketplace, know the technology and how it fits into that marketplace.
A sense of one's own boundaries. We occasionally get guys come in that are the team, they're the quarterback, and they're going to throw a long pass and then run down the field and catch it. Those aren't the people we fund. So you need to understand what you're good at, what you're not good at, and have a plan to supplement yourself with people who are really, really good at things that you're not.
Echoing Jim's comments about coachability, absolutely. That humility, yet at the same time the expertise within the domain. They have a connection to the industry in which they're hoping to have customers, have a proven relationship there that they can monetize.
Cool. So we'll kind of go on kind of the fly here for a few more questions. So you've invested, a company raises angel rounds. What are some success metrics that you measure for investments that you have? Is it, so you've invested, do you just sit back and relax, or what are some of those indicators that help you believe that company is progressing, both from a financial perspective and just a company progress perspective? We'll go with Gary and Jim on this one.
Well, meeting your own goals. So if the entrepreneur has set goals that he expects to, or that he's trying to get investors to recognize, meeting those goals is a key thing. Those goals usually come in terms of market share or cash flow.
We invest in businesses. Businesses are defined as having customers that pay the business more than it costs them to deliver it to the customer. So we look for revenues first, revenues second, and revenues third.
Cool. So now we'll ask Curtis and Tim, how do angels or investors in general make money? Into the exit. They should.
Well, you put money into a company at a lower valuation than the exit, and you make money on the exit. That's pretty simple. We invest in companies. We're investing in equity, very much like investing in public stock market, but you're investing in private companies. and you're investing at a rational, reasonable entry point, and you help the company to grow through interactions with the company and connections with customers or investors or other vehicles, and hopefully ultimately the company grows to a point where someone else larger than them wants to acquire them and pays a nice premium for that.
That time horizon that Nathan was alluding to, I think it's critical to understand that and say, this is not something in which we're going to get monthly interest payments. It's not a real estate deal. This is the antithesis to your traditional real estate. This is totally unsecured. These are investments that hopefully an indication of success along the way would be that they complete what we might call a Series A. If we're a seed round as angels, that next time that that company is raising money, it's typically called a Series A, and there's Series B, and the list goes on. You hope that perhaps that exit, that IPO, that window of 5 to 10 years tends to be a great way to be patient, and hopefully you'll see milestones along the way.
So I think what's critical here is really the way you make money is when a company exits, right? And the valuation at which you get in is really important. If as a company you're raising $1 million at a $4 million pre-money valuation, that means the company after investment is worth $5 million. Let's say you're successful and you sell for $50 million, which in Arizona is a good win, right? So 5, you grew to 50 when you exit. That means all of the investors, assuming we'll make this simple, no other investment was raised. That means every investor will have returned about 10 times their original capital. Now, what if instead the investors invested at a 10 million post-money valuation? Instead of making 10 times their money, they make 5. And so you can see why valuation is very important. And really, the fundamental of investing is buy low, sell high.
Let me add a wrinkle to your calculus here. If we invest in an uncapped note, which we'll never do, and the conversion occurs 2 years later at a 20 million valuation, it's uncapped, and we converted that 20, you're cutting it in half again.
Yeah.
What they're describing is called dilution. You're being diluted out of your return.
Yeah.
Now I want to add to Nate's numbers. So keep that $50 million exit in mind. And the premise was that the investors are investing $1 million and everybody else is invested at the same rate. So there's $5 million of actual investment. Well, a company, when we invest $1 million and you're the founders, you may have $100,000 in total capital in the company. And at exit, you get $40 million on your $100,000 investment. We think that's good for you because we've made 10 times on our $1 million investment. So if you think that making $40 million on 100,000 isn't enough by a few $1,000s, then we're probably not going to be good partners.
Exactly. And do you invest with the intent of running the business?
Nah. Fact is, I've been a CEO of software companies and other kinds of companies 7 times. If I wanted to run a company, I'd go find a company to run. We are all minority investors. We are looking to start out with, you heard conversation before about the founders, the entrepreneurs. We're investing in the entrepreneurs. So we want them to run the business as long as they are doing the best thing for the company. At some point they may not, and the person may have to be replaced. But no, we're not interested in taking over the company through subterfuge or any of that.
Yeah. So I think that the key here is diversifying a portfolio means you cannot control every investment, right? I don't know on average how many deals you guys average per year, but I think, Curtis, you said over 20 last year?
We did 24 last year.
24 last year. And it's impossible to control every single company and run it like your own. But if that is super important to you as an investor, that's fine, but maybe investing through a big syndicate will not be the right fit. It might be, okay, I'm investing in 1 or 2 companies, knowing that I'm going to get heavily involved because otherwise there's a lot of conflict in your heart. I think that's something that you have to introspectively look at yourself and say, okay, can I do that? Am I okay playing the influence card more than the I own the majority of your company and we're doing it this way card, the control card?
And we do try to help every investment that's made. And that's something, going back to the very first question, is why we do this. It is very difficult, if not impossible, to pick up the phone and call, if you own Coca-Cola stock, you can't pick up the phone and call the CEO and say, hey, I think you should watch out for those Pepsi guys. But here in this asset class in the early stage investing, you can easily pick up the phone. If you're an investor in the company, the CEO is probably going to answer your phone call and want to have a conversation with them. So you get to interact directly with management and the top management.
Yeah, Gary?
With respect to this idea of investor control, investors really don't want to control these companies. We're investors. We can't dedicate our time to doing this. Investors do ask for certain kinds of control. They might ask for, well, there might be something in the agreement with the investor that says certain things that you do, you might have to get investor approval, like you can't sell the company, or you can't sell part of the company, or you can't sell the intellectual property of the company without our approval. There may be some things that investors want, but they don't want to run the company day to day.
Good. So, I think we've ran through all our questions on the list. We'll go down the line real quick. Anything that we have not covered that you think is relevant either to the entrepreneurs in attendance or potential angel investors? We'll start with you, Tim. Lightning.
I think we should look at deal structure. The angels, through various vehicles that exist now, individual LLCs, if there are more than 3 to 5 members of our group that want to invest in the company, typically we as Canyon Angels will form an LLC, pool our money, and go into that company as one entity. We do that for 2 reasons. 1, it mitigates the administrative burden on our members. 2, it lowers the threshold entry for investment. We can sometimes go as low as $5,000 to step into one of those investments. And 3, to the entrepreneur, it doesn't crowd up your equity table.
Yep. Jim?
We all represent angel groups, which means that we are collaborating with each other to make decisions about investing in a company from the start through the end of it. We see tremendous leverage in doing this together by using everybody's brain power to the advantage of everybody else. There are angels out all over the place that make decisions entirely on their own, and it's a perfectly legitimate way to do things. But if you do it on your own, you're going to have to do all of the work or pay for somebody to do some work for you. Whereas we have lots of people with lots of backgrounds that participate in our processes, and we think that the ability to have lots of viewpoints enables us to take some of the risk out of the situations, which means that we get the reward for the nominal risk, but we actually take a lesser risk to get that reward. So we think it's economically sensible. It's also a lot more fun than doing it on your own.
I'm going to speak to the investors in the room. I know this event was somewhat framed to try to bring new angel investors who maybe are curious about what angel investing is into the fold. So to the investors in the room, the most important thing is you have to create a portfolio of investments. I know we've said this before, but I'm reiterating. You can't bet on one horse and expect it to be the one that's going to be the next Uber or Facebook. So you have to create a portfolio of investments across, in my opinion, a broad diversity of geographies, stages of the company, and technologies. So I personally don't pick a vertical and invest in one vertical. I want to invest in a broad swath of investments across many stages and geographies, both in and out of Arizona. Sorry. So create a portfolio. So if you're coming at this new, figure out how much money you want to devote to investments in early stage companies, and then divide that up into 15 to 20 bites, and make that your investment check size that you can invest. Or you can invest in one of our sidecar funds, very self-serving, invest in one of our sidecar funds, and those investments will get spread out on your behalf.
I too will talk to investors for just a moment. Angel investing indeed has a very long time horizon, but I don't want to overstate the time horizon. Sometimes angel investments can pay off early. If a company is successful, oftentimes management wants to buy out that early stage angel investor. And there may be some baked-in incentives for him to do that, depending on what the original structure was. So other companies buy out target firms that we angel investors have invested in. It's not unusual to have an exit in 3 years or 4 years or even a couple of years if the mix is right. So while we would all say plan on 5 to 7 years maybe, it's possible that you could be out of an angel investment a lot earlier.
Thank you.
For better or for worse, bankruptcy seems to happen sooner rather than later.
They call that the J curve, Tim. So in investing, they often refer to it as the J curve, right? So the first couple of years is when the majority or a significant amount of your portfolio might be losing value, but a lot of the returns come on the upside, which is that J perspective. And so I think there's multiple ways to get out of the company. We covered 3 of them. The 4th one that we didn't cover was secondary shares, where you might sell your shares to another investor or back to the company, hopefully at a higher price than when you invested, to get some money out if that's of interest to you. So what we want to do now is turn the time over to the audience for some Q&A for about 15 minutes here. And let's see, Spencer, do you have a mic, or do we want to run a mic around? If not, you can.
Down here.
Or we can give you a couple mics.
Hello.
Perfect. All right, right here, and then we'll jump across the aisle and then keep going around the room.
Hi. So if someone was potentially interested in getting involved with what you guys are doing, being a part of one of the angel investor groups, I think we've all kind of seen the Shark Tank or the profit, like bad deals being made. And so sometimes I get the impression that investors can kind of get that poaching stigma. And so are there things that you guys, I guess, do, or do you feel like that's even like something that you're concerned about? If someone said, hey, I'd want to get involved with what you're doing, but I also don't want to be looked at like a Shark Tank jerk.
Yeah, so Shark Tank is, just think it's like Spider-Man. You don't jump off of a building because you watched it in a movie. Shark Tank's entertainment.
Sure.
You know, there are lots of companies that allegedly get funded that never ever see a dollar from anybody. It is a TV show for ratings and advertising. So it's not at all like what we do. So we deal with our entrepreneurs face to face. When we've made an investment, we've got a vested interest in their success. So the idea of sort of doing a number on them is really not in our DNA because it's counterproductive. It's like taking a gun and shooting yourself in the head.
I think if you ask any of the companies that have been through our process, which is in the hundreds, you'll find that there's nothing below board with what we do. I mean, Arizona is a fairly small state, fairly small ecosystem, fairly small community relative to the rest of the country. We can't have a bad reputation. So,
question is, how do you tap into the expertise of your angel investors? So everybody will have some expertise that is complementary to the
Speak
others.
up, please.
So are you speaking as an investor or speaking as an entrepreneur?
Investor.
So in our case, we talk to each other all the time. We've actually created a member database now that our members are populating, which gets into very, very fine granularization of what people's expertises are, because what we want to do is tap into somebody who has some real expertise in the question that you're addressing. And we share that with everybody in the group. So you know that if we're in the middle of diligence and you're the deal lead on some deal and you need somebody to look at some particular aspect, you can figure out from this who among the group is the one that's closest to it. And if that person doesn't have the answer or the ability to respond directly, that person probably knows other people outside the group that does. And now this is a pitch for Arizona. People really do collaborate in this state. And it's easy to ask people for help and they give it.
for us, when a company's presenting at a dinner meeting, when they've made it through to a dinner meeting, the people in the audience who are asking the questions that I don't understand or other people don't understand, those are usually the people who know the industry and are the ones who get a lot of interest in the company, good or bad.
Good. We have a question back here, and then we'll come over here.
So something that I would be curious to hear, you mentioned, some of your investments are out of state, some are in state. How do you guys feel the quality of the ecosystem stacks up against other markets? What are the positives? What are the things that could, improve upon? Just kind of that general theme.
Hey, Gary, why don't you take the...
Well, in my prior life, before becoming a professor, I ran a fund in California. And so I got to see in deals all across the country, because we had about $130 million fund that I ran. I can tell you that, especially recently, the deals that I personally have seen here in Arizona are as good as anything I saw across the country. And in fact, Arizona in the healthcare area, I think we'd all have to agree that we really shine now. I was shocked to see, but but the largest single component of Arizona's GDP is healthcare. I didn't know that until I went to check a few months ago. And we have some very strong healthcare companies and upcoming technologies here in the state.
Yeah, and so our fund invests in the greater Southwest, so Arizona is about half our portfolio, but then it's also the adjacent markets of Utah, Colorado, and Utah primarily. And I think what we see is the quality of ideas in Arizona is on par with anywhere else. What we still have a way to go on is the sophistication of the entrepreneurs and really understanding not just the company, but the metrics around raising venture capital, what it means to go from a good idea to building an investor network to strategic partners, and not just focusing on Arizona as a customer base, but your competition is the world, and you really need to understand that. So I think that's something that we still are doing better on each year, but we can never be complacent that we've arrived, because relative to other markets, we still have improvements that we can continue to make.
Just to tap onto that one point, traditionally angel investing is very regional. You would literally invest within a 50-mile radius of your own home. I think that's beginning to change now. I think we're starting to see regional syndications. We have our angel event tomorrow at 10 a.m. Here on campus. We have 4 companies pitching, 3 of which are coming from out of state.
So, a detail I should have added when I did my introduction, 92% of the dollars we've invested have stayed in Arizona. So the deal flow, so 37 million, 92% of that has stayed in Arizona since January of 2010. The opportunities, the deal flow, the quality is spectacular. My opinion, and this may not be a popular one, it's harder and takes longer in Arizona than other places. We have a dearth, irrespective of Nate and Brian Burns, who I saw sitting in the back, there is a dearth of venture capital in this state. So after the angel round, if you're growing the company very quickly and you need a large influx of capital to grow, it's very challenging to find that here in Arizona. That's a problem we need to fix. The ACA, I almost said the Arizona Commerce Authority has been tremendously helpful in promoting events and pitch events, and the AIC and the angel tax credits are very valuable to us. So we're growing, we're all working very hard on it, but we have a ways to go.
Good. Okay, next question.
I've got 4 points that I want you to cover that I think is necessary. First thing is from the entrepreneur's point of view. When you guys pick a deal, do you pick it on what it is or why they're doing it?
Go through all 4 and I'll write them down, then we'll hit them.
The next one is when you structure your deals, what we've seen in Silicon Valley is they at your stage, they take 80%, their valuations based on 80% of the Series A valuation to avoid a new fun thing the IRS came up with, which is a 409A valuation problem, which creates tax problems for everybody. My last question is, on the when I join your angel group, do you guys send me a K-1? Do I get it from the companies? And that's my question.
You're asking a lot of specific questions, which we can go over in some detail later. But so the bigger issues are, we're not interested in taking over a business. We're not interested in pricing something. 80% you're talking about is really the discount in a convertible note. That's where you get that from. We are much happier investing in preferred stock, where we have an actual price rather than something that will be determined by somebody later. The K-1s all relate to whether you do LLCs or not. There are specific answers to very specific questions in specific situations.
In the 409A one, though, does affect people.
You do a 409A whenever you're going to do any kind of renewal of your options. You have to do that.
I think there's a meta question, though, that's important to answer, in that we are all groups of individuals. We are meeting on a monthly or on a regular basis to look at opportunities to invest your own dollars. We are not acting as a fund investing other people's dollars. So from our groups, you're not going to get a K-1. It's the companies you're investing in. If they're LLCs, or as we don't necessarily guess for, if they're LLCs, you'll get a K-1.
And I'd say from our fund perspective, we do not invest in LLCs. We make the company convert over to C Corp to remove that issue of collecting potentially hundreds of K-1s over the life of multiple funds. And then in terms of deal structure, it's really driven by the industry standard, right? NVCA has forms online. If you want to go read them, standard deal docs, term sheets, and everything are available online for NVCA forms. That's a best practice. Don't get too creative, because if you get creative, the next round of capital will get more creative and put you in a slightly worse position. So keeping it standard is very good practice across the board.
And my big question is, when you pick a deal, do you pick the what? Because when you're having people fill out forms online, it's hard to find out the why. The why is the entrepreneur. That's the passion. Somebody actually used the word passion once but that's really what you're looking for, aren't you? I mean, you say you don't want too much passion, but that's what's going to keep people. I don't know if you tell your entrepreneurs it does take 10 years. That's the greatest thing after going through this for 40 years. That's the greatest thing, the most honest thing that came out of this.
Yeah, I'm not real big on the word passion, because every single entrepreneur that we've ever met says they're passionate about their business. So it's not a defining characteristic. It is a presumption that they're going to be passionate. The why is solving of a problem. If that's what you define as why, then that's what we're interested in. We're not interested in technologies in search of a problem. We're interested in problems that an entrepreneur, a group of entrepreneurs have defined, and then come up with a solution that is much better than the other solutions around. And to some extent, we don't care what the problem is, as long as it's a real problem with enough people that have it and are in positions to pay for it.
Yeah, and I think in general you can invest in two trends. One is a market trend, ride sharing. Everybody wanted to get into, I won't say everybody, but a lot of people wanted to get into a ride sharing company because that was a trend, the market was growing big. Over time, those tend to consolidate. And the second would be more of an execution play where they've got that unique differentiator that can be sustained over time. And then it's more of operations, how will they execute on that? The best is when you're riding a market trend and you have unique differentiation, which I think is the underlying theme in investing is every company you invest in, you probably think it's going to be the winner, right? But in all reality, how everything shakes out, you get 6% that are the big winners, and the other 94% is some spectrum of making a decent amount of money to losing all your money. So I think that's the caveat is we always think every deal will be successful, otherwise you wouldn't put money into it. But then the law of life shakes out. Okay, let's do one in the back, and then we've got two up here, and then I think that might be it for the questions.
I don't need mine. Being a fund who's put out $10 million for the actual investors, one of the things that I would always tell you, and I've learned now, you've got to come up with a system of how you're going to communicate. Is it nothing more frustrating, right, when they don't communicate with you, right? And that's the one thing that I've noticed coming from California and New York. Arizona doesn't have a good process for that. They're not used to it. They don't know how to communicate. So how often do you guys want them to communicate with you? You just picking up the phone on a Saturday, giving them a call, or you want it quarterly, or when there's good news? What do you want?
Are you talking about the angels within the group or portfolio companies?
I'm talking about the angel groups. When do they want to hear from the companies they invest in? Because you have entrepreneurs in the group. They have no communication plan. And I think it'd be helpful that they have that communication plan. So that's why I'm asking.
Okay, so question is, what's your preferred method of communication from entrepreneurs? Is there a set rhythm, and kind of what is that cadence that you prefer?
Timeline, monthly. Prefer monthly. There's a platform that one of our portfolio companies is using called Reportedly.
Okay.
It's phenomenal. The entrepreneur is being great about giving us the highs, the lows, and his needs, and a snapshot of financials and metrics. I'm sure there are other platforms, but it behooves every entrepreneur to communicate with your investors. The worst thing you can do is go silent and then run out of money and then call up your investor, hopefully more than 2 weeks out, saying, we're not gonna make payroll, what do we do? You know, if you've been communicating with your investors the whole time, they know the story, they know the ups, the downs of what's been going on with the company, and we'll help you, see into the future and see the problems coming.
Yeah, good. So I think that's, in general, the recap. Monthly is awesome. Quarterly at a minimum, include financials. and because that way you can't hide anything. And I saw a couple hands over here. We'll do this one, that one, and then we'll end for the day. Right here, and then we'll go to the last section.
I think Curtis said you guys are a collection of individuals. It would help from an entrepreneur perspective, but probably if I was a potential investor, to just know who like those individuals are. Can you give just a picture of like, are we talking old, young, male, female? What's the background? People invest as people, and it would be good for me to understand who we're talking about here.
Yes, it's the whole spectrum. Male, female, old, young. Generally speaking, angel investors are going to be older in age because they've probably been either cash entrepreneurs or successful C-suite, and they have capital, disposable capital to invest in companies. I'm sure we're all working very hard to attract a younger population to our groups to sustain the group. But, and also the question is industry. I mean, that's the beauty of an angel group is when you get together in the same room and listen to a pitch, you have people from assessing it from every perspective, be it technological, legal, accounting, professors, people from the industry. So there's a lot of power in the collective knowledge in a room.
I would add one more thing to that, and that's we are poster children for diversity because we are looking at these problems from different perspectives. So we want to encourage as many people from as many different backgrounds as possible who are interested in investing to come forward and become parts of our groups because their unique backgrounds, whether it's a demographic difference or it's an experiential difference, actually adds value.
I just wanted to add that the ACA has some great information on the diversity within angel groups across the country.
Last question.
Do you have a recommendation for dry powder per investment made that you make to your members?
There are two basic theories about how to invest in what we do. One is called one and done. You take the dollars that you have and you divide it up by the amount, as Curtis suggested, to get to a unit of investment, and you diversify your portfolio. So each company gets one investment. And the other strategy is you invest deeply, repeatedly, in companies that you really care about, whether because they're great opportunities or because you're protecting your initial investment. Two different ways of doing things. There are a lot of people who only invest one time in a company, and there are others who invest multiple times, sometimes happily, sometimes not, in companies because they think that's the right way to go.
Great. Well, thank you, panelists. Appreciate your insight today. Thank you all.